Good day to you all. My name is Vino Mapetere and I'm from Chartered Accountants Academy. Today I would like to take you through the taxation of individuals, and particularly I'm talking about income tax of individuals in Zimbabwe. Some quick key learning outcomes. First of all, it would be good to identify and understand the key differences between the taxation of individuals and that of corporates. This recording assumes for students, you have already studied the taxation of corporates, where the key income tax principles have already been introduced around your gross income, any exemptions to that gross income, the allowable deductions and any changes to those deductions, bringing you to your taxable income and how you can then apply the relevant tax rates. So we want to build from that knowledge. And even for a practitioner, there's that understanding, or there's that assumption that you would know these key fundamentals around gross income exemptions, allowable deductions, prohibited deductions. So we will only be building on the element of what happens with individuals in that broad framework. We would also want to understand the taxation of employment income and how it differs from taxation of trade and investment income, both being income for individuals. So an individual can have employment income, or they can also have trade and investment income, two types of income which will have different ways of being taxed. We would like to leave the room understanding the tax planning for individuals. What are the key issues when you are assisting with the planning of taxation of for individuals? We could also look at tax administrative elements. So for the taxation of individuals and how it differs from the taxation of corporates, firstly, I would look at employment income is earned by individuals only. So you can't have a corporate earning employment income with an employer. Key sounds silly, but it's a key and fundamental difference. So what does it mean? As you now do individual taxation of individuals, we're bringing in a different type of income called employment income. For individuals, trade and investments normally are not prominent, but in this growing Zimbabwean informal and thriving informal economy, this taxation of trade and investment section for individuals is increasingly becoming significant, to a point where when you look at the last 2-3 years, there's been a lot of introduction of either presumptive taxes or withholding taxes, just so that we can tap into most individuals who are now running, to use street language, side gigs. It's now a gig economy, side hustles. So a lot of people have formal employment where pay as you earn is formally deducted, but they're probably selling wares, and there they are earning trade and investment income, which is very difficult to trap or detect. So there's various methods which tries to bring these people into the net, as it were. The responsibility to account for tax lies with the employer for employment income. So that's a fundamental departure from what you've learned for taxation of corporates. With taxation of corporates, what we're saying is you earn income and you are responsible for doing that return and accounting and paying. So the responsibility lies with the taxpayer. But with employment income, yes, it's the individual who has earned the income after offering their employment services, but it is now the employer who is now responsible for ensuring that that income is taxed. So the employer will do the necessary deductions, and the employer as well will be responsible for then going on to remit that tax to the tax authority. And then another major departure or difference is the tax risk. Obviously now for employment income lies with the employer. If the employer has not done the necessary processes to collect and remit the tax on behalf of the employee, the risk lies then with the employer in terms of any penalties, any interest, and any other non-compliance punishments that can come through from not accounting for taxes properly. In terms of tax planning, there's a difference in emphasis and special considerations under taxation of individuals. Like I said, in the past, in a highly formalized economy, the emphasis lies with employment income and less on trade and investment. But in an informalizing one, I think that emphasis is slightly shifting. There are administrative differences, obviously expertise, the registration requirements on the part of the employer. You do have individuals now easily getting tax clearances. I saw an administrative element, what they call TAMS, which is a ZIMRA system where taxpayers are now able to actually online go and register themselves, get a tax clearance certificate, albeit 6 months, and be able to transact and account for their taxes. So let's start with employment income. Section 8(1)(b), as read with the 13th schedule, deals with any income that is employment income. And I think central to it is remuneration. So employment income is defined as income earned by an individual. So then for services that they are rendering under a contract of employment, and any amount that they received due to cessation of employment. So you can still have employment income coming through way after cessation of employment. The services could only have been rendered, but they may be yet to be rendered. So you're not going to say, look, you have not done the work, so a payment that was made in advance or in lieu will still be in gross income, regardless of the section 8, I think it's 3, that then says if someone hasn't performed yet, you'll have to defer that income to a time in which they will have performed those services. The amount could be due and payable or not, for as long as it has been received or accrued. So you're looking at complexities like cash in lieu of leave, and say, is it due, is it payable? Looking at bonuses, constructive obligations. So those things, one would need to carefully look into them to determine whether or not to include an amount in gross income. You still get employment income on cessation of trade. That amount may not necessarily be for services rendered, but for cessation of employment now. And at that stage, when you have those terminal benefits where someone is getting them gratuitously or what, so you'd need to look into that and say, how do we treat it for income tax purposes? The employer-employee relationship here is central for it to be called employment income. And we've got a number of tests to say, was there an employer-employee relationship? And central to it is the concept of remuneration. So, for example, one can engage someone and say, if you sell 20 of my products, I will give you a commission of 10%. And you can have two people with that arrangement, and one is deemed to be an employee and the other one is just deemed to be a consultant who's running on the sales. So we would need to test whether the commission itself is not conclusive, whether there's an employer-employee relationship. So there's tests that we would need to apply. So moving on, what is an employee? Because now we want to test employment income by checking an employer-employee relationship. And it's an individual to whom remuneration is paid. So keyword for me, two keywords, individual and remuneration. That's why I said you can't have employment income between two corporates. So what is remuneration? Remuneration, it means broadly any amount of income which is paid. So you're then given examples of remuneration such as salary and so on and so on. So this is quite broad. But again, some of these items, it's not conclusive because some of these elements can be found like commission or a fee. It can be paid to a non-employee or to an employee. So we'll keep digging. It excludes things like trade and investment from independent contractors, directors' fees, board chairman for statutory entities, and so on. So you also have third schedule exemptions. They will not come into your employment income. Amounts paid to partner by a partnership is not employment income. Reimbursement of expenditure incurred by employee for the purposes of employer's trade. So here we're saying your employee travels to Bulawayo, and then maybe they have a breakdown, you had given them some contingency, you had given them lunch money, now they take more time and then they buy more food and then they come back and make a claim. When you pay them, it is not income to the employee, it is just a reimbursement of expenditure that they would have incurred. And therefore it has to be incurred by the business, by the employer and not by the employee. Commutation of portion of pension on or annuity not forming part of gross income. So those are examples of exclusions. But once we have conclusively determined the employment income, we then load that employment income into gross income. As you can see here, Section 81B allows us to do that. And then just like we do with corporates, we say, so what are the exemptions? Section 14, as read with the third schedule, we identify. Remember, exemptions are a list of items that ordinarily qualify under the gross income definition, but they're just a list that says, please don't tax people on these things. So for example, if your employer, an employer contributes to a medical aid scheme of an employee, to the employee because someone has paid their bill, that's income to them, but that income is immediately exempt. So such examples would then be found. You would have included it in gross income, but you then remove it as an exemption. Once we do that, we come up with our income, and then we remove the allowable deductions on employment income. Very few, but whenever an employee can prove that for the purpose of their income they've incurred these costs, then they can get the deduction and exclude any prohibited ones. But this section is very thin when it comes to employment income, because remember, largely employment income is not viewed as trade per se, so it's very difficult to have connecting expenses that can be said for the purpose of trade when you're referring to that employment income above there. Then you also have, once you have that taxable income, here comes the fundamental difference as well between corporate and individual tax, in that what then happens there is you do not apply a flat rate, but you apply a progressive rate. So you say 0 to 20, 0 to so much, it changes every year. Say 0 to 200 is tax-free. And then 200 to 300 is 20%, 300 to 400, 25%, and so on. So in the example I've just given you, if someone is earning $365, what will happen is you'll say 0 to 200, 0. And then you say 200 to 300, 20%. So I'll say 20% of that 100 in that bracket is $20. So I put the tax, 20 plus 0. I now have a cumulative tax of 20. And then from 300 to 365, because that's our limit, I have $65, and that's being taxed at 25%. So 25% of 65, it's about $16 something, $16.25. And you say $16.65 plus the $20, you get $36.25 plus zero. So total tax becomes that, $36. So that's a fundamental difference, the application of tax tables that change from year to year. And then once you have that tax on income, the issue then becomes you are allowed to then remove credits, which you don't find for corporate tax, by the way. Credits are just another leverage way, which is different from exemptions, where yes, this is your tax, but we are against your tax, we're going to credit you. And there's 4 primary reasons why, which we'll see later on. And these can be found in the Finance Act, the Charging Act, so that you know how much and what type of credits are available. You then apply your AIDS levy, which is 3% of that taxable income. And remember, every month for employees, you're not waiting till the end of the year to do this assessment. During the year, deductions were being done on a month-on-month. And remember, the salary and the other employment income differs every month. And so what will simply happen, and also the tax brackets will change, which I was talking about. Remember, they're annualized. So they can change because you never got to the end of the year. So they run what they call a final deduction system that always tries to realign year-to-date gross income and what has been deducted so far. So it recomputes every month. Month 1, it computed based on what was available. When it got to month 2, because of some fluctuation, the year-to-date can change the bracket in which this person is projected to fall in. And once that change happens, it calculates with a revised projected tax bracket in mind, and then it recognizes what happened last month, and then it makes a deduction that tries to factor in all those things. That's what we call a final deduction system. So after 12 months, we will say this is what the final deduction system was doing. Ordinarily, because it was self-correcting along the way, it should not be too far off from the final assessment. But what stands becomes the final assessment, and therefore you can have a tax payable or even a tax credit at the end of the year. Okay, so moving on. Administration of pay as you earn is a responsibility of the employer, section 71 and 73. For those that are practitioners, you need to familiarize with this just to make sure your systems are aligned and your processes are aligned as well. Systems, by systems, I'm talking about IT systems. Employers are required to register at a certain threshold. Whenever you have employees that are hitting a certain threshold, they have to withhold payee and remit it by the 10th of the following month, following their deduction from the employee. The employers are responsible for under deductions as well as late payments of payee, which is the tax risk I was referring to at the beginning. The interest is charged, and penalties of up to 100% of the unpaid taxes can be imposed on the employer. Personnel employed by a single employer for the full fiscal period are taxed on the final deduction system, and I think I've just explained that. And it's a final tax. In other words, you're not going to be refunded. And then, like VAT, in some cases, you can be refunded. And then personnel employed by more than one employer or employed for a part of a fiscal period who receive pensions and annuity from trade investments are required to submit annual tax returns. When you're not in the circumstance that I've just explained there, you are not required to do any returns. You are leaving the employer to deal with the returns issue in the administration. But when you have the circumstances I've just described, then you are required yourself to fill in a return about your income, right? You also have circumstances where you have additional benefits under the employment income, specifically under employment income, are benefits where you have a salary and all that, but then there's benefits you're being allowed to use a house, you're being allowed to use a car. All these benefits are taxed. Sometimes they don't have a dollar value, straight dollar value attached to them, and then you have to deem them and you have to have rules. And these rules normally, by default, they refer to the cost to employer, but in certain circumstances, they then shift to the value of what the employee has received. So specifically, motoring benefit, this one is for the right to use a car, and the benefit is deemed to be based on the engine capacity. If you're using a car of this size, we deem you to be receiving this kind of benefit. It has nothing to do with mileage. It scopes out repairs, fuel. All those things are not part of the benefit. In fact, if you're then receiving fuel, then that's a separate benefit, but not repairs. Deemed it's based on the engine capacity. And then disposal of motor vehicle to an employee, and where this disposal is at favorable conditions, the reference is made to the value to the employee. What would I have bought this car for, but what have I bought it for? So where is the benefit and how much have I benefited? Passage benefit, section 8.1G, when you are relocating from one place to another for the first time, because of employment, you have received you have not received a benefit, but any excess from there, it's now a benefit. Occupation of residence and furniture, very difficult to say. So how much is it? Because you can't charge the cost of the house and the furniture. So we refer to the value to the employee. What's the market value? And if there is furniture that is bought, it's a percentage of that cost, maybe 7% or so. Loan benefit, whenever you get a loan at favorable terms, the difference between what it should have been and what it is. And what should have been makes reference to liable. So the Zimbabwe Tax Act says 1% plus liable. So every time you would say, what is the London Interbank overnight rate? That's liable. And then you say, okay, so if it's 4%, add 1, that makes it 5%. How much did the employer charge the employee in terms of tax? We charge 6%. So there's no benefit there. But if the employer charged 2%, then the difference between the 6 and the 4% becomes the loan benefit. Shares acquired pursuant to an employee share option scheme. All the conditions must be exercised, approved, and so on. So these are examples of employee benefits. Those are examples of how to determine what the amount to include in gross income is. I thank you.